Hey guys, Ron Parks here and welcome back to the channel. I want to talk today about why I would stay in the real estate market. The real estate market has been one of the most volatile markets over time, but particularly at the moment, it is just going up and up, especially in certain segments of the market. Now you might be looking at the real estate market right now and thinking, well, that with housing financing costs being low, thanks to the pandemic and the slow economy, well, that's a sign to get your feet wet and buy your first property or trade up to a bigger one. Due in large part to COVID-19, mortgage rates have hit record lows since early 2020. Although buyers have reported growth in their home buying budgets and lower monthly payments, additional factors make the question, is this a good time to buy a house? A really difficult one to answer. Lower rates may entice buyers, but it's essential to consider the broader economic picture before going through with a home purchase. If you have a good credit score and you can pick up a 15-year mortgage for less than 2.75% interest, which is a decline from last year when rates were about 4%. Now think back to when we had finally recovered from the whole mess in 2008, and the time was ripe to buy. If you bought in 2009 to 2011, then you got in on low prices. Everywhere it seems like people are buying. Real estate is just really trendy right now. It doesn't matter where, rural, suburban, vacation, well, they're all looking up and home sales are hot. And if you work from home and in a rental apartment, you probably yearn for more space. So purchasing a house seems wonderfully enticing, especially with very low mortgage rates. Now, working from home may demand a bigger space. Since COVID-19 began, many of us started working from home. And what may have started out as a temporary measure has really stretched into months and almost a year of avoiding the office when possible. And as you spend more time in your current home, you might find that you need a larger space to function effectively. And depending on your situation, it might be time to stretch your legs in a bigger home. Now we're in a seller's market, a very strong seller's market. With that, home buyers are facing rising home prices across the country. And as the market continues to shift in favor of sellers, buyers may want to hold off on a home search. Otherwise, they can be dealing with high prices and few available options. And getting in at the high end of the market also has its risks. If the market corrects, you'll be the first to hit hard with the paper losses. The National Association of Realtors did a recent study and found the following as of February 2021. The national inventory of homes available for sale declined 48% from last year. And the inventory of newly listed properties also declined by 24% nationally, and 23% for the large metropolitan areas. This shows that there are much less houses available for sale. In addition, the February national median list price was up 13.7% compared to last year, and the large metropolitan areas saw an average price gain of 11.5%. All of this bodes really well for sellers, but not great for buyers. As the economy improves, well, there were almost 400,000 new jobs created last month under the new Biden administration. There should be an increase in demand for homes, but I would consider some of these factors in your favor if you want to buy. Number one, do you have enough of a financial cushion to get you through if for some reason you lose your job or you have a financial setback? Do you have the down payment and transaction costs set aside? Well, if you're on the borderline of having these, you probably should wait. You have to have available not only the monthly mortgage payment, but property taxes, insurance, maintenance costs, and repair costs. Now, you might get a mortgage for $2,000 a month, but after you add in all of these extra costs, it might be as high as $3,000 a month. So can your cash flow and budget handle that? Okay, number two, keep the loan as flexible as possible. Now, even though 15-year fixed loans are a point to a point and a half lower than 30-year loans, a 30-year loan will give you a lower monthly payment. And you can always add a payment or two during the year to bring the loan term down to a 15-year amortization. And if you get a 15-year with a larger payment, you really can't reduce it, and you're stuck with that payment. Okay, number 3, think about getting into the market if you're going to keep the home for 5 to 7 years, because appreciation usually takes time. And if you're planning on holding the home shorter than this, you might have lots of trouble breaking even off of the purchase when you sell. Now, your gain is already reduced by the closing costs you incur, as well as the 5 to 6% commission you'll need to pay to sell the property. So the longer you hold it, the better chance you'll make a profit or not lose much money. And number 4, in addition to your emergency fund, we have talked about that you should have 4 to 12 months of cash to carry you through. And if your income stops, you should also have a fund for unexpected housing expenses. Now, things break down, and the unexpected will always happen. So, okay, now that I have given you the general summary, let's run through some of the fundamental things you should be thinking about on whether to buy a house. Number 1, don't follow the herd. You won't grow your money just by following what everyone else is doing. This is a jump off a bridge aspect of investing. Right now, the real estate market is overloaded with buyers. Sellers know that their properties are in demand as inventory is low, so you have many more buyers competing for a property, increasing the selling price. I just put on a listing in a beautiful area of Palm Springs, and in 18 hours, we had 5 offers, and the property sold way higher than the sellers ever expected. Great for the sellers, but really not that good for the buyers. And nowadays, many people are looking to buy larger homes, given that many of them have had to incorporate a home office to work remotely from. These are understandable incentives, but stop and ask yourself how much you're paying for your property right now. Do you have the reserves if you suddenly lose your job? I don't think you have to look very far in this country to find someone that's been laid off during the pandemic. They're just worried about paying the rent, let alone even thinking about buying a home. And you're also not taking into account what happens next. We're in a very comfortable place right now. But what happens when the market corrects itself by 10 or 20%? So the biggest problem with following a trend is that eventually the ones to adopt it last are the ones that lose out. The time to buy may already passed, and you don't want to be the last one still wearing a members-only jacket well after the 80s have ended. Okay, number 2, foreclosures and evictions are on the way. Here come the evictions. Right now, the new administration is doing what they can to keep a moratorium on evictions and foreclosures. But we know that's not going to last forever. And a federal court just ruled that it's unconstitutional. Mainly if they were generous at the start of the pandemic, they're now hurting. So sooner than later, the banks are going to come to collect. CNBC reports that 4 million homeowners have requested mortgage forbearance or adjustments or reductions to their mortgage payments. Well, currently banks are not charging late fees, but unpaid mortgages do add up. Eventually, those banks will have no choice but to foreclose on a lot of these properties. And number 3, when you're considering whether you should buy now, avoid the impulse to buy a shiny object. Consider the current low interest rates as a shiny object. It's what the magician is going to dangle in front of you while he's pulling the rabbit out of the hat. Yes, interest rates are indeed at an unbelievable low right now. People don't want to miss out on borrowing money without worrying about getting stuck with an exorbitant rate. But if you look at history, you'll likely start considering the evidence that there will be upcoming foreclosures and evictions. And when the rents invariably fall and real estate prices drop, your cash flow asset, if you have an investment in a rental property, may quickly drop into the negative. Some experts already see the real estate market weaken as the pandemic rages. So the interest rates are certainly attractive, but they also won't last. And if you're planning on riding high on low interest without much in your reserve, you're setting yourself up for a failure. Even a low rate can quickly kill that strategy. And number 4, we go to unemployment. I'm sure you know someone that has lost their job during this past year. That's because the unemployment rate has risen to higher levels than it did during the recession of 2008. Millions of Americans are out of work. 60% of the businesses that had to close are not expected to make a comeback. And the pandemic threatened our very way of life, and some people pursued home buying as a way to feel more secure. It wasn't just impulse buying on Amazon that we're all guilty of because we were cooped up and going stir crazy. Some people purchased new properties to feel like they had some control over their housing environment, like moving from a crowded city to the suburbs. And given all of that, I find it hard to believe this sudden influx in home buying is sustainable. Remember, the market thrives on supply and demand, and eventually it just won't have the supply available. The supply of homes is low and currently shrinking, thanks mainly to a new home builder's weary outlook on the whole industry since 2008. It's also low because as prices have risen, many people can't trade up to a new or a larger home. And personally, if you have a rental, I would consider sitting tight on it rather than buy for now. Owning a house can have factors you don't consider, like repairs. Those costs can account for 4% of a new home the first year. So why not just put that money aside while the market's so uncertain into rent? Well, it's just safer and could make more sense for you. And if you're thinking of buying a rental property, well, you might want to make sure you can handle a loss if the rental market prices drop and values start to go down. If your strategy is to ride the interest rates into glory, I think you should rethink it. To me, it just seems like poor planning. If you're currently renting, assuming you have the cost for the down payment in hand, that money can work for you while you wait for a more balanced market. True, putting that sum in a bank account or certificate of deposit will earn you a minuscule amount of interest. But you can do much better by plugging it into an S&P 500 mutual fund with low fees. And the big overall question is, will a less crazed housing market ever come back? Well, that hinges on the end of the coronavirus pandemic and what states start opening up their economies. So I started this out by saying, yes, I would continue to buy. If you have a good down payment, if you have reserves, if you have emergency reserves, and if you really want to have some security of not being at the will of a landlord, then it is a great time to buy. You just have to shop around and make sure you can get a reasonable price. And while we're talking about real estate home buying, I'm going to talk about a general rule. It's the 30-33 rule. The 30-33 rule states that you should spend no more than 30% of your income on a mortgage, 30% of your home value should be in investments, and you should not pay more than 3 times your annual income for a house. So if you make $100,000 a year, you should really not look for anything over $300,000. And of course, if you have significant assets in cash and investments, then this 3 times your income is really not applicable, because lots of people have invested and saved and have substantial assets to supplement their work income. Related to the 30% of your home value in investments, this might sound like a lot, especially since there are programs that allow you to make a smaller down payment. But during times of high uncertainty, it's better to have a larger financial cushion. Homeowners who got blown out the quickest during the previous recession had minimal down payments, which increased the temptation of them to walk away from an underwater mortgage. And those who did between 2008 and 2012 missed out on one of the largest real estate booms we've ever seen. If you plan on buying within the next 6 months, keep at least the 20% down payment in cash so it's available and you can move quickly on a purchase. It's unwise to invest your down payment in stocks and other risk assets if your home buying time horizon is short. The truth is, no one has a crystal ball here. We are truly living in an unprecedented real estate market. And the question is whether or not you think it will stay agreeable for an exceptionally long period of time. History shows that real estate is an excellent investment over the long term, but there are cycles and many ups and downs. It's probably best to take a look at some historical financial benchmarks relating to real estate to help guide you when you're in doubt. Okay, so thanks so much for watching. I think I've given you a broad view of some reasons why you should consider buying now and some reasons why you might want to wait. I hope you learned a little from this. And if you did, please go ahead and smash the like button. And if you're looking for additional content, be sure to subscribe and click that little notification bell to get updated as I upload. I try to post twice a week, if not more. And I'll see you again soon. And thanks so much.